Hi, everyone, and good evening. Welcome to the first session of Bullseye Gyan. Today, we have with us a very seasoned investor and very famous Mr. Vivek Pethri from FinCounsel Accounting and Mortgage Broking. Welcome, Vivek.
Welcome, bhai. How are you?
Good, thank you. And thank you for joining us today. Thank you for getting time out of your busy schedule on a Sunday evening. So, Vivek ji, today we want to speak to you about the subject of various entities that you can buy a property in. So, can you please start by throwing some light for our viewers? What are the various entities in which a property can be purchased?
Jas bhai, the first thing everyone does is buy in their own name. So we call them the individuals. The next one is as people buy more, they suddenly find that the borrowing capacity is getting impacted, or for tax planning reasons, they buy it in trusts. Then you become more complex. Let's say you get into development, then people start buying it in companies, and then obviously there's another avenue of buying. When you've got sufficient fund in your superannuation funds, SMSFs, then you buy property in that. So these are the general ones.
So, we looked at four options: buying in personal name, family trust, companies, and then SMSF. Correct?
Yep. Yes.
So, if we ask you what are the advantages and disadvantages of buying in your own name from your perspective?
In your own name, I think the advantages primarily is every lender will lend to um someone to the individual. They're not much enough, and then the other advantage is the 50% capital gains benefit if you're buying an investment property. If you're selling your own home, there's zero tax on capital gains. If you're selling your own home, PPOR that we call. So these are the main ones, and obviously uh, there is an estate planning thing also in there. After you, how do you transfer the asset to the next generation?
Got it.
That's These are the advantages. The biggest disadvantage is there's no asset protection.
No asset protection, a
Yeah,
very
if you do
important.
something wrong, uh, in a common parlance, and someone wants to sue you, they can look at all your investments, all your assets, and
So,
take it
can
to.
you say that very sensitive and high risk jobs, and please correct me if I'm wrong, like doctors and other similar professions, may consider buying even their principal place of residence not in personal name but in a different entity?
Yes, in our accounting practice, we actually suggest anyone who's a professional who's giving advice, you should probably buy everything in a different entity, uh, for these reasons, for asset protection reasons, and that's why the primary driver, I think.
Right. So our first takeaway that we learned from Vivek today was about the four different entities that you can buy your principal place of residence or investment property in. The second takeaway is that professions like doctors, others who are in very risk-prone professions should probably buy their principal place of residence also not in their personal name but in some kind of trust. Very good point. So, if I may ask, when it comes to the second entity of family trust, what do you see as the advantages and the disadvantages of the same, please?
See, the first of all, we need to remember in the Australian law, the life of a family trust, or for that matter, a trust. Because there's another type of a trust called a unit trust, which I will put it under the category of partnerships, etc.
Hmm.
But all trusts have a life of 80 years.
Hmm.
So the biggest advantage is that one generation buys, there's no transfer of the asset to the next generation, and they can still benefit from it.
Hmm.
So the other is also in terms of estate planning. Somewhere, like, if you don't want, like I say, like, given that if if you buy something for a young person, let's say a 20-year-old who wants to buy an asset,
Hmm.
um, And if they buy it in, let's say, a trust, and in a family trust, or the parents buy it, I'll put it like that, the parents buy it in the family trust, they can actually and transfer the asset to the after themselves to their children after they have, let's say, crossed a 55 60-year age. So then their families would have settled down a little bit. So that's one of those things. For a family trust, many people buy it. The other is to maintain their borrowing capacities, because some lenders do not look at trust loans if we are not using that as a liability. We're not using any income from those trusts and companies. So you can
Right.
save borrowing capacity there.
Right. So when it comes to tax, suppose we buy an investment property in personal name and an investment property in a family trust. Does family trust give you the same advantages of interest rate deductions, tax claims, etc.?
In the trust, negative gearing is not really coming transferred to the individual. Losses are not transferred to the individual. So in that sense, negative gearing to an individual is uh, not beneficial, like what we do in an individual thing. So that's quarantine. It's not loss, because it's somewhere down around the sixth, seventh, eighth year. We hope that your property becomes cash flow positive in the tax term balance, and then the prior period losses can actually offset those gains.
Got it. Got it.
So around the 12th year, 13th year, I think most of the people that I have seen in my experience, on the 12th, 13th year, the trust actually starts paying tax.
Okay.
But that gets, we don't really pay, but we pay that money to the beneficiaries actually, and then it gets taxed.
Right.
Before that, it's like around 4 5 years tax free.
Right. Right. If you move to the third entity, the trust companies, what are your views on that? Whom does it
No,
suit more?
I will probably remove the word trust. I'll just talk about simple companies,
Yeah. Sorry.
because trust we have already covered.
Hmm.
Companies normally have an indefinite life, so it's managed by the trustees, by the shareholders,
Hmm.
and they appoint the directors.
Hmm.
Um, that the advantage is that no one in the trust, like in a trust, all income has to be distributed. In a company, that money has doesn't have to be distributed. Now, if it's simply an investment vehicle, the company, then the tax rate is 30%. Now, this tax that has been paid, if you look at from an ASX perspective, any of those companies, those they pay dividend, and they have something called the imputation tax credits.
Hmm.
So, company, if you're having a company that has paid tax, so that can also get you get a dividend in the future when your incomes go down, you get that benefit. So, yes, today the company pays the income tax, but tomorrow you can get it back as a credit whenever the dividend is paid.
Got it.
So that's something I do. But in a company, remember, capital gains tax is there's no exemption for capital gains. So from the first dollar you pay the 30% tax. If you're doing something like a more active business, like development, many people are doing, then it become an active business. Then we can look at the 25% tax rate that many people think it is. So passive investment, 30% tax. Active business, 25% tax.
Got it. Got it. Got it. Got it. Right. And if we come to the last entity, SMSF, please share your thoughts on that.
SMSF, I'll probably say, is not for everyone.
Mhm.
So need to get a financial planner advice when you're looking at setting it up, and whether property investment is a good uh, investment strategy for them.
Hmm.
As an accountant, I can say you can use your funds, you can manage those funds, and you have got those advantages.
Hmm.
the um, So normally right now, as a broker, I'm seeing people who are having around 170, 180
Hmm.
with decent incomes. They can buy investment properties. We have got lenders who do 90 LVR loans, but most of the people buy at 80 LVR because the rates are just prohibitive. SMSF rates are more on the commercial lines. You can get around 7.3 rates currently. Hopefully, on when the rates come down, it'll be slightly lesser, but still it'll be around the 7% compared to current owner occupied, that's around the 6%. So
Right.
you can say around 1.25 rate difference out there, easy.
Right.
Um, Then
Right.
SMSF is your personal, normally your personal liabilities and incomes are not looked into, but there are options where they, if you're, especially for small businesses, if they're option, if they're short of servicing, we can look outside what is happening outside the SMSF to ensure that you can fund the commitments.
Right.
So, but yeah, but one thing benefit of an SMSF is actually it's a big chapter, 15% tax rate on the income. Um, then after you retire in the pension phase, there's no income tax, and we can go on and on. Actually, it's a big chapter of discussion here.
Right. Right. Just to let everybody know that Vivek actually wanted this session to be a very long one because he said I can speak on each of these questions for 1 hour. But I said we can't have a 1 hour session. So I asked him to just throw some light on each of the entities. And if you have questions about each of the entities, you know where to reach out Vivek to. We will be sharing his phone number and his contact details in the post of this Facebook post or the YouTube post that wherever we put this video out. All right. Thank you, Vivek, for throwing light on those four entities: individual names, family trust, company setup, and SMSF. Now, good that we have you both as an accountant and as a mortgage broker. In your vast experience, for a normal average Australian, what is the best way to improve his lending capacity, and what will be the typical journey for this person based on your experience? And this you can take your own sweet time to answer.
Thanks, Jazz. See, I don't know what the best is because everyone is so special. So it all depends on personal circumstances. I can probably give the journey of some of my clients who have built more than 10, 15 properties.
Mm,
Um, Number one, they start as obviously the wife says, I want a house. So you buy a house in your own name, the principal place.
mm,
Um, then the next purchase they buy it in their own name again. That's an investment property.
mm,
Then by the time they reach the third property, the son is realized that, oh, I don't have a borrowing capacity.
mm,
So then the journey stops and they wait for 3, 4 years for savings to go up and the property to go up and the borrowing capacities come up because of the
mm,
incomes going up.
mm,
So what I always recommend is before you do the third property thought at the second property, you start thinking in terms of trust,
mm,
buying it in a trust structure.
mm,
And again, it could be a company, depend on the personal circumstances, but most of the people go down the trust structure.
mm,
And then they buy the property in a trust. As I had mentioned, alluded to previously in the conversation,
mm,
many lenders, there are a few lenders, not many, but a few lenders who will not look at liabilities within a trust when assessing. So if you buy, let's say, property number two in a trust, you can, if you want to buy a property number three and the trust, you have the money, yeah. So, and you want to exclude property two liabilities, then you can buy and in property in trust number two, and you buy the third property in trust number two. So you can actually do it. So many people do that, and we have got people who would doing like if you're looking at developers, if you look at typical developers, they do like they have got this trust, they do one development, there's another trust which does another development, and a company is there. So we're just sort of mimicking that, and it's a good tool and a bad tool, but ultimately remember the risk is the individuals who is borrowing because they have to commit to, because they are guarantors in the trust for that loan,
mm.
and they can be, if you overgear yourself, there is a risk of default, so it's critical. Yeah, bhai.
Hmm. So
Yeah,
Vivekji, you just got you froze because of some internet issues in the last 30 seconds. Can you just repeat
yeah,
from the point where you mentioned they are the guarantors in the trust, so they have to commit to the repayments and the remaining part of it, please?
yeah. So they have to commit. So basically, we have to be responsible borrowers. That's very important. Overgearing can lead to stresses. Like we have seen a lot of people when the rates were 2.5%, they thought the rates are that's normal. And when the rates hit 6%, then suddenly we found people selling houses for no reason. Had they always thought, okay, let me work at 6-7% because that's the Australian average for the long term, those stresses wouldn't have come. So similarly, I'm talking about if you're doing something, don't overgear yourself just because your income is today. It's like, you're making a commitment for, because you're buying a property for around 10 years. Think long term, not 1 or 2 years. So
Right.
that's critical out there. So balance. Yes, we have got a tool to increase your borrowing capacity, but balance that risk. Otherwise, because property performs over a decade. So if you
Mm.
don't manage your risk well, you basically end up losing money. So and money doesn't grow on trees, as we know all.
Mm. Mm. Correct. So that is how you propose that first go for your principal place of residence in your own name, then probably go for investments in trust. Correct?
Yes,
If you need
and
to, right?
and and when, like, if you have, let's say you don't have any much income, then you can buy, and you can actually sit with your accountant, do tax planning, boost your super base. There's a rule called carry forward rule. Your accountant will be able to explain it better, and then use that to boost your, and then you can buy in your SMSFs. In that, for the 2-3 year period, buy it in SMSF, and then you come back to your normal routines of trusts or individuals, whatever suits you best.
Right, right. So this was for an on average Australian, but if we have certain people who are in very high risk professions like doctors, there are IT professionals who are working on their own ABN, contracting with companies, and they can be, facing kind of risks. It's a very high risk job. They can have risk from their with whomever they're contracting with. For them, what change will you propose in this normal process?
See, obviously, let's assume it's a doctor. He just passes out because they are the most risky. The lawyers are also the riskiest professions
Hmm.
compared to accountants and IT guys. IT guys are the least risk.
Okay.
So because they're still coming under a rule called PSI, most of the guys that I've seen, I
Yeah.
haven't seen a IT guy who has a very risky profession as such.
Hmm.
But coming back, so so very high income, and I'm not meaning this someone who's earning 250, 300 as high income. You're
Hmm.
talking about like someone who's earning 600, 700. Those are high income guys.
Hmm.
So let's say you come at and you're a doctor, you just pass out of uni. I will suggest they buy it in a trust
Okay.
because you're playing with individual's life, and if someone's life is lost for an error that has been that can be identified to the doctor, then it's better that he buy if it's bought in a trust, then actually the asset is protected. Because if you look at it from the trust deed, the, the asset belongs to the trust, not to the beneficiary.
Hmm.
So if there's something known as lifting of the corporate veil concept in law. So if we apply that into this, if you have not done anything wrong deliberately, no one can take away the asset, even if you're a beneficiary. So that's where the trust becomes a good tool to
Right.
avoid unnecessary hassles.
Right. So in the case of doctors, lawyers, what you suggest is from day one, they go for a family trust structure and do not buy anything in their own personal name because of the risks associated with their profession and
That's
the
right. Asset protection being very critical there.
asset protection. And that is one of the biggest strengths of family trust that comes in play. Right. And good. So when it comes from the perspective of just a investor, should he, what do you recommend? Buying one property in their own name, one investment property in their own name to take benefits of the taxable deductions, etc., or
I mean, it's
claiming
not
the
it's
deduction?
always a good idea because if you look at it, if you're buying in a trust, the negative gearing is not there.
Hmm.
So if it's not there, so your borrowing capacity when the interest rates are high comes down.
Hmm.
So in that sense, yes, you first build your asset portfolio in your own name, and once you're saying, oh, the next property will be a problem, or the second property from now will be a problem, then you buy this immediate property in a trust.
Got it.
So
Got
that way you can, and if you have got enough sufficient funds, you can preserve your borrowing capacity and you can go ahead and buy a few more. subject to the inherent risk I told about over leveraging.
Got it. Got it. And at what instant should a person start considering SMSF? Suppose I have bought first my principal place of residence or in my own name. Then I started buying investment properties in trust. And now, at what instance should this person start considering to buy in SMSF?
See, that's more of a financial planner because it suits on your investment strategy. And then, as an accountant, I'm not authorized to talk about investment strategies for the asset class. I can say that once you have around 170, 180, there are lenders who will lend you if you have got sufficient contribution coming in every year.
Hmm.
But you are in a safer bracket around the 250, 300 if you have got that much money in your super fund.
Okay.
Yeah.
Okay. Got it. Got it. All right. That's all for today, viewers. Vivek is based in Sydney. He's the founder and director of Fin Counsel Accounting and Tax and Mortgage Broking. If you have any questions regarding this, the subject matter expert is Vivek, and we will share his contact details in the description of this post or YouTube link. Thank you for joining us today, and thank you so much, Vivek, for your time today. I'm sure we have just touched over on the top, on the surface of most of those entities, those four entities: personal name, family trust, company setup, and SMSF. And our viewers will definitely get in touch with you for any further details or guidance that they need. Thank you so much for today.
Thanks, Jasbhai, and best of luck to Bullseye and the viewers. Thank
Thank
you.
you. Cheers. Bye bye.